A few months ago, I found myself in a situation that many traders experience but rarely admit. I fell into revenge trading. I had been following a strategy one knew well, one I had tested over months with strict risk management rules. My maximum loss per trade was clearly defined, my entries and exits disciplined. On this particular day, the market moved against a position I took, hitting my stop loss. It was a small, controlled loss, nothing catastrophic, but the emotional impact was immediate. I felt frustrated, annoyed, and suddenly convinced that I had to win back what I had just lost. This is the very essence of revenge trading, and it's a psychological trap that can destroy even the best prepared traders. When we talk about trading discipline, one of the most destructive behaviors a trader can develop is revenge trading. Revenge trading is one of the most common traps a trader can fall into, yet it is often misunderstood. At its core, revenge trading occurs when a trader takes a new position immediately after a loss with the intent to recover the lost capital. It's not a calculated adjustment to your plan, it's an emotional reaction. Understanding this behavior requires acknowledging that the root of the problem is not the market, the strategy, or the timing. It is the trader's own mindset. When you engage in revenge trading, your decision-making becomes compromised. Instead of following a carefully constructed trading plan, the impulse to win back what was lost overrides discipline. You might ignore your usual risk parameters, over-leverage positions, or enter trades that do not meet your setup criteria. Over time, these behaviors compound losses rather than mitigate them. Research on retail traders consistently shows that individuals who react impulsively after losses tend to lose more than traders who stick to their strategies. For example, in studies tracking behavior after consecutive losses, traders attempting to recover immediately often increase their losses by 50% or more in a single session. This demonstrates that revenge trading is less about strategy failure and more about the emotional response to losses. Understanding the triggers behind revenge trading is essential. The first category of triggers is emotional. A loss generates frustration and anger, sometimes combined with a fear of missing out when the market continues moving in the direction you anticipated. These emotions can escalate rapidly, pushing a trader to chase profits without evaluating risk. Another category is situational. External pressures such as personal financial stress, family obligations, or losing streaks can heighten the urgency to recover losses. Even the simplest distraction can amplify impulsivity, making it more likely that a trader will abandon their plan. Cognitive traps also play a role. Thoughts like, "I need to win to prove myself, I can recover this loss now," or, "I know the market is due to turn," reinforce a false sense of control. These beliefs are rarely conscious, yet they have a powerful impact on decision-making. The psychological mechanisms driving revenge trading are deeply rooted in how the brain processes reward and pain. Losing money activates neural pathways associated with discomfort and stress, which the brain naturally seeks to alleviate. Dopamine plays a critical role here. The brain anticipates a positive reward, the recovery of lost funds, to relieve the negative feelings associated with a loss. This neurological response explains why the urge to enter a trade immediately after a loss can feel almost involuntary. Moreover, overconfidence following winning streaks can exacerbate this behavior. When profits are attached to your identity, losses feel not only financial but personal, creating an urgency to restore that sense of competence. Recognizing the role of emotional balance is crucial. Traders who can pause, step back, and evaluate objectively consistently outperform those who react impulsively. Emotional balance allows a trader to interpret a loss not as a personal failure, but as day-to-day signal to adjust or simply wait for the next setup. Developing this awareness does not happen overnight, but it can be trained systematically through a combination of journaling, self-reflection, and disciplined adherence to a trading plan. One practical method for identifying patterns of revenge trading starts with self-auditing. Track your emotional state before, during, and after each trade. Record not only the outcomes but also how you felt and the impulses you experienced. Was there a strong urge to recover a loss immediately? Did frustration or anger influence your trade sizing or entry timing? These notes provide valuable insight into moments of vulnerability. Next, identify recurring patterns. Are there certain market conditions, times of day, or personal stressors that consistently precede revenge trades? This step transforms subjective experiences into objective data. For instance, some traders notice that after a losing streak in volatile markets, they are more likely to overtrade in an attempt to recover quickly. Recognizing these patterns allows for preventive strategies. Honest self-reflection and journaling are not optional, they are central to breaking cycles of revenge trading. Writing down not only the trades but the thought process behind each action forces transparency and accountability. Over time, this practice strengthens your ability to recognize impulses before they result in poor decisions. The journal becomes a feedback loop for emotional training, providing clear evidence of what triggers destructive trading behavior and how to intervene. It is also important to reinforce the concept that recognizing these patterns is not a one-time effort. Each trading session presents new variables, both market-related and personal. Continuous tracking and evaluation allow the trader to adapt strategies for maintaining emotional equilibrium, which is ultimately the edge that separates consistently profitable traders from those who repeat the same mistakes. In addition, visualization techniques can complement journaling. Before entering the market, mentally rehearse potential losing scenarios and plan your responses. This preemptive training conditions your mind to react calmly rather than impulsively. For example, if a loss occurs, the pre-planned response might include stepping away from the screen for a short break, reviewing your plan, and only returning when emotional neutrality is restored. This method reinforces emotional control and strengthens discipline over time. Finally, understanding the cumulative impact of small impulses is critical. Revenge trading is rarely about a single trade, it is about a sequence of emotionally driven decisions that erode capital and confidence. By documenting patterns, identifying triggers, and training preemptive responses, a trader gains the ability to disrupt these sequences. The goal is not to suppress emotions completely but to recognize them, understand their influence, and make decisions that align with the trading plan rather than the momentary desire to recover losses. Triggers are the underlying forces that transform a single loss into a chain of destructive decisions. Identifying them is not just about awareness, it is about building a preventative framework that protects your trading account and your mental clarity. The first category to examine is the emotional response to losses. Frustration is perhaps the most immediate trigger. When a trade moves against you, the natural response is irritation or impatience. This frustration often manifests in attempts to immediately reverse the loss through new positions, bypassing your plan and risk management rules. Anger is closely related but carries a different intensity. It can arise not just from losing money, but from feeling wronged by the market itself, or from the perception that a setup should have worked. When anger drives your actions, trading becomes personal rather than analytical. Anger amplifies risk-taking because the objective shifts from executing a plan to proving a point to the market, or even to yourself. Similarly, fear of missing out, or FOMO, is a subtle but powerful emotional trigger. After a loss, you may convince yourself that the next trade must be taken immediately, lest you miss a rebound. This urgency overrides rational analysis and causes overtrading, per timing, and sometimes entering trades that do not meet your criteria. Situational triggers are equally critical to recognize. Losing streaks are a classic example. Even experienced traders experience clusters of losses, and the compounding emotional impact can be deceptively strong. During such streaks, the brain begins to associate the act of trading with stress rather than opportunity, which increases susceptibility to impulsive decisions. External stressors, family issues, financial pressure, or work-related anxiety can exacerbate these conditions. When personal stress intersects with market stress, emotional control is compromised. Traders under pressure often deviate from their rules, take larger positions than intended, or enter trades without waiting for confirmation signals, which multiplies the risk. Impulsive reactions are frequently triggered by these stressors. They bypass deliberate thought and rational analysis, often occurring in microseconds, yet their consequences can be immediate and severe. Cognitive traps represent another layer of vulnerability. These traps occur when internal thought patterns reinforce destructive behaviors. One of the most common cognitive traps is the belief, "I need to win to prove myself." This mindset transforms trading from a process-driven activity into a validation exercise. Each loss becomes a personal judgment rather than market feedback, and every new trade is a chance to restore self-esteem rather than execute a strategy. Another frequent trap is the conviction, "I can recover this loss now." This sense of urgency is deceptive because it implies control over the market that does not exist. Traders often underestimate risk, overleverage positions, and abandon stop-loss discipline in pursuit of immediate recovery. A third cognitive trap is the illusion, "I know the market is due to turn." This belief assumes predictive power where none exists, often leading traders to fight the trend or enter premature positions based on emotional desire rather than objective setups. Recognizing these triggers begins with structured observation. Emotional responses, situational factors, and cognitive patterns must be documented in real time. Before executing trades, make a mental or written note of your emotional state, external pressures, and thought patterns. This level of awareness may feel cumbersome initially, but it builds the foundation for identifying the moments when revenge trading impulses are likely to arise. Tracking and analyzing this information over weeks or months reveals consistent patterns. For example, you may notice that certain trading sessions, such as after large news events, are more likely to evoke frustration, or that personal stress coinciding with volatile market conditions produces a higher frequency of impulsive trades. Developing interventions for these triggers requires a methodical approach. For emotional triggers, one effective strategy is the pause and evaluate technique. When frustration, anger, or FOMO appears, step back from the screen. Assess the loss objectively. Was the trade aligned with your plan? Were risk parameters respected? Could the outcome have been anticipated or mitigated? This pause allows the emotional response to dissipate and gives cognitive control the opportunity to reassert itself. Situational triggers require proactive planning. Losing streaks can be anticipated, so implementing rules such as a maximum loss threshold per day or session can prevent reactive trading. External stressors should be acknowledged and managed outside the trading environment. Simple interventions like scheduled breaks, limiting trade size, or avoiding the market during periods of high personal stress reduce the likelihood of impulsive decisions. Cognitive traps are mitigated through mental rehearsal and structured reflection. For example, Prior to trading, visualize potential losses and establish a pre-planned response. Rehearsing scenarios such as, if I lose this trade, I will wait at least 30 minutes before entering a new position, strengthens neural pathways for deliberate action over emotional reaction. Journaling each trade, not only for results but also for thought patterns, helps to identify recurring cognitive distortions. Over time, this practice rewires the mind to recognize, question, and correct erroneous beliefs before they influence behavior. Understanding the interplay between these triggers is also important. Emotional, situational, and cognitive factors rarely operate in isolation. More often, they combine to create a heightened state of vulnerability. For instance, a trader under personal financial stress who experiences frustration from a losing streak and believes they can recover it now is at extremely high risk of revenge trading. Recognizing the combination, rather than only individual triggers, is critical for effective intervention. Furthermore, measuring the impact of triggers quantitatively can enhance awareness. Track metrics such as trade frequency after losses, average position size deviations, and risk-to-reward ratio adherence. By analyzing these metrics in conjunction with emotional logs, traders gain a clear, objective picture of when triggers are influencing decisions. This creates actionable insights for refining trading discipline. Finally, it is essential to internalize that triggers are not failures, they are natural responses that can be managed with training and awareness. Professional traders who master the identification and mitigation of triggers gain a significant edge over peers. The process involves systematic observation, disciplined journaling, mental rehearsal, and pre-planned interventions, all of which strengthen emotional resilience and reinforce adherence to a trading plan. The focus is not on eliminating risk or emotion but on ensuring that emotions and external pressures do not dictate trading decisions. When examining the psychology behind revenge trading, it's important to understand that it is fundamentally an emotional reaction to a loss, rather than a strategic decision. Losses, no matter how small, trigger an immediate physiological and psychological response. The brain interprets a losing trade as a threat, activating the same pathways as physical pain. Dopamine, the neurotransmitter associated with reward and pleasure, drops sharply after a loss. This chemical signal drives the mind to seek immediate relief, often pushing a trader toward impulsive behavior. This is the core reason why many traders feel compelled to get it back immediately. They are not making rational decisions, they are reacting to the brain's desire to restore a sense of equilibrium. Consider a real-world example. Suppose a trader executes a well-planned trade according to their rules, but the market unexpectedly moves against them. The loss triggers frustration and disappointment, but the mind doesn't stop there. Thoughts such as, I need to win this next trade to break even, or I can predict the next move and recover this loss, begin to dominate decision-making. These thoughts feel logical in the moment, but are actually cognitive distortions fueled by emotional imbalance. A single reactive decision in this state can escalate into a chain of revenge trades, compounding losses rapidly and often more severely than the initial loss. Overconfidence also plays a subtle yet significant role. Traders who have experienced a winning streak may start to feel invincible, believing that their edge is unshakable. When a loss interrupts this streak, the reaction can be disproportionately intense. The mind attempts to reclaim control, not necessarily to make profitable trades, but to restore a sense of competence and validation. Over-identification with profits and losses further amplifies this issue. In this state, account balances are no longer neutral figures, they are reflections of personal worth, success, and intelligence. Every point lost or gained feels like an emotional verdict on the trader's skill. The problem is that markets are indifferent to personal feelings. They respond only to probabilities and price action. When a trader's ego becomes entangled with trading outcomes, the likelihood of revenge trading increases exponentially. Developing emotional balance is therefore essential. Emotional balance is not about eliminating feelings, it is about recognizing and managing them so that they do not dictate trading behavior. A trader with emotional balance can pause in moments of heightened emotion, observe their internal state, and make deliberate decisions aligned with their trading plan. For example, after a loss, a balanced trader might notice the spike in frustration or impatience and deliberately review their trade plan before executing any new trades. This pause allows for an objective reassessment, reducing the likelihood of impulsive entries driven by the desire to recoup losses immediately. One of the most effective methods to develop this edge is through real-time emotional monitoring. Before, during, and after each trade, a trader should ask themselves targeted questions. Am I reacting to fear or frustration? Is this decision consistent with my plan, or am I attempting to fix a prior loss? Am I trading because the market presents an opportunity, or because I feel compelled to recover psychologically? By answering these questions honestly and recording the responses, traders begin to notice recurring patterns in their emotional responses. Over time, these insights become invaluable, allowing the trader to implement preventive strategies before emotions compromise decision-making. Cognitive biases also heavily influence revenge trading. The belief, "I need to win to prove myself," is a common mental trap that overrides rational judgment. Likewise, thoughts such as, "I know the market is due to turn," or, "If I just take one more trade, I'll recover everything," are examples of distorted reasoning driven by an emotional need to regain control. Recognizing these biases is critical because it allows a trader to implement tangible countermeasures. For instance, one practical technique is to pause after any loss and engage in a simple check. Review the next trade objectively against the original criteria. If the trade meets the conditions of the plan, it is executed. If not, the trader steps away. This step, simple as it may seem, acts as a buffer between emotion and action, preventing destructive patterns from unfolding. Case-specific analysis further reinforces the importance of this approach. Reflecting on my own trading, there were numerous instances where a single loss triggered a series of revenge trades. Each trade initially seemed like a rational attempt to recover losses, but in reality, they were purely reactive, driven by emotional urgency. By examining these patterns, I could identify the triggers: frustration, anger, fear of missing out, and implement preventive strategies. One of the most powerful lessons was learning to dissociate the value of my account from my self-worth. By recognizing that a loss does not define my skill or intelligence, I could approach subsequent trades from a neutral, objective state, reducing the impulse to engage in revenge trading. In addition to awareness and cognitive checks, journaling is a cornerstone practice. Documenting not only the trade outcome but also the emotional state and reasoning behind each decision creates a repository of behavioral data. This log enables pattern recognition over time, recurring emotional triggers, types of trades most susceptible to reactive behavior, and market conditions that elicit strong impulses. With consistent journaling, traders develop a heightened sense of situational awareness, allowing them to catch potential revenge trading impulses before they manifest. It is also essential to integrate preventive routines into daily trading practice. Simple exercises, such as short breathing sessions or brief pauses between trades, can create micro moments of reflection that significantly reduce impulsivity. Another method is pre-commitment. Before the trading session, outline a clear plan with entry and exit criteria, risk parameters, and contingency measures. Having this plan written and accessible acts as a guidepost during emotionally charged moments, reminding the trader that consistent execution, rather than reactionary trades, is the path to long-term success. The consistent application of these principles builds resilience. Over time, traders who prioritize emotional awareness and balance cultivate the ability to view losses as neutral data points rather than personal failures. This mindset shift fundamentally alters trading behavior. A trader who once felt compelled to immediately recover losses now approaches the market with patience and objectivity, executing trades based on plan adherence rather than emotional reaction. This disciplined approach not only reduces the financial damage from revenge trading, but also reinforces confidence in one's methodology, creating a self-reinforcing cycle of consistent performance. By understanding the physiological, psychological, and cognitive underpinnings of revenge trading, and by implementing deliberate strategies for emotional balance, a trader gains a measurable edge over those who act impulsively. The key is consistent practice, real-time emotional monitoring, cognitive checks, journaling, and preventive routines are not one-time interventions, they are ongoing habits that shape professional behavior. Mastery over these elements allows a trader to maintain discipline under pressure, make objective decisions, and transform potential setbacks into learning opportunities. Your focus should shift from just understanding the psychology behind revenge trading to actively auditing your own behavior and identifying patterns that leave you vulnerable. Self-audit is not about judgment or guilt, it is a systematic approach to collecting data on your decision-making process, emotional responses, and recurring triggers. Think of it as constructing a personal dashboard that tracks not only profits and losses, but also the underlying behaviors that drive your trading outcomes. Without this insight, it is impossible to consistently prevent revenge trading, because the habits and impulses that lead to it often operate below conscious awareness. The first step in a self-audit is to track your emotional state rigorously. Begin each trading day by assessing your mindset. Are you calm, anxious, overconfident, or distracted? Record these observations in a trading journal. After each trade, note the emotions you experienced before entering, during the trade, and after exiting. Were there moments of hesitation, frustration, or impulsive excitement? For example, in my personal review, I noticed that losses occurring during mid-afternoon trading often triggered stronger impulses to fix it, compared to losses taken early in the session. By logging this consistently, I identified temporal patterns that were invisible in real time, allowing me to implement proactive measures, such as taking breaks or adjusting position sizing during vulnerable periods. Next, focus on identifying recurring triggers linked to revenge trading. These triggers can be emotional, situational, or cognitive. Emotional triggers include frustration, anger, fear of missing out, or the desire to prove oneself. Situational triggers might be a series of consecutive losses, external stressors such as personal or financial pressure, or even market conditions that are inherently more volatile. Cognitive traps often manifest as irrational beliefs. If I just trade once more, I'll recover everything. Or, I know the market is due to turn. Document each instance carefully, noting the specific trigger and the context in which it occurred. Over time, patterns emerge. In my own case, I observed that a losing streak of 3 trades in particular always sparked an urge to take aggressive, high-risk positions. Recognizing this pattern allowed me to implement a rule: no more than 2 consecutive trades in the same direction without taking a structured pause to evaluate. The journaling process should extend beyond emotions and triggers to include a detailed analysis of the trades themselves. Record entry and exit points, position sizes, adherence to your trading plan, and deviations from strategy. When reviewing these logs, ask yourself, Were my actions driven by the market setup or by the need to recover prior losses? Did I follow my predefined risk parameters, or did I increase exposure impulsively? This dual-layer analysis combining behavioral data with trade metrics provides a comprehensive view of how psychological impulses translate into concrete trading actions. For instance, I discovered that revenge trades often involve doubling down or increasing leverage immediately after a loss. Simply being aware of this tendency allowed me to enforce strict position size limits during sessions when frustration was high. An essential component of the self-audit is creating preventative protocols. Once you have identified high-risk patterns, implement measures to mitigate them. This might include mandatory cooling-off periods after a loss, pre-committing to a maximum number of trades per session, or setting alerts that remind you to follow your trading plan. For example, I introduced a rule where after any loss exceeding my normal risk threshold, I must step away from the screen for at least 30 minutes. This pause interrupts the emotional loop and allows for a more rational reassessment. These protocols are not arbitrary restrictions, they are structured interventions based on empirical observations of your own behavior. Over time, following them consistently trains the brain to respond to losses with deliberate analysis rather than reflexive action. Another powerful technique is to simulate what if scenarios during the journaling review. Imagine situations where a loss triggers a typical revenge trade and write down alternative responses aligned with your plan. What would have happened if you paused instead of re-entering the market? How could you have redirected emotional energy into analyzing the next setup? By mentally rehearsing these alternatives, you build cognitive resilience, reinforcing neural pathways associated with disciplined decision-making. In my own experience, this exercise significantly reduced the frequency and intensity of impulsive trades. It transformed moments that previously led to heavy losses into opportunities for reflection and strategic planning. Peer accountability can also amplify the effectiveness of a self-audit. Discussing your behavioral patterns with fellow traders or mentors introduces external perspective, often revealing blind spots that are difficult to detect alone. In my case, sharing my journaling insights with a mentor helped identify subtle emotional triggers I had overlooked, such as the tendency to take revenge trades after a period of personal stress unrelated to trading. Collaborative review creates a feedback loop that strengthens both self-awareness and adherence to preventative strategies. Lastly, it is vital to understand that self-audit is a continuous process, not a one-time exercise. Markets evolve, personal circumstances change, and psychological vulnerabilities shift over time. What triggers a revenge trade today may not be the same in 6 months, and new patterns may emerge. Therefore, review your journal regularly weekly, monthly, and quarterly to detect shifts in behavior, refine preventive protocols, and reinforce successful strategies. In my personal trading journey, consistent auditing allowed me to move from reactive trading to proactive strategy execution. The result was not just improved profitability, but a significant reduction in the stress and anxiety historically associated with losses. By implementing a structured self-audit, traders gain a level of insight that transforms the trading experience. Emotional reactions become data points rather than uncontrollable forces, and patterns that once led to destructive revenge trading can be managed proactively. This practice equips traders with both awareness and actionable steps to maintain discipline, adhere to their plans, and navigate the inevitable ups and downs of the market with professional composure.